Looks like many have joined, so I think we'll go ahead and get started. Good morning, and thank you for joining me for our post-election market update. I'm Angela Palacios, a partner here at the Center for Financial Planning and Director of Investments. For those of you getting used to this new Zoom format, I want you to note that you can submit questions for me through the Q&A function at the bottom of your screen. I'll pause periodically, and our moderator, Jacqueline Jackson, portfolio manager here at the center, will let me know if there are any questions coming in. So I'll get to as many as I can, but if you still have questions after we're finished, feel free to reach out to me or to your planner via email, and we'd be happy to respond. I'll have my contact information posted at the end as well, in case you don't have my email address handy. So today I would like to give just an update on the election from last week and what's happened so far and with the markets this year as well. We'll take a look back kind of at some information on politics and how markets are affected by them. And then we'll look forward to what we can expect from our new government and how this may affect markets. So in case you missed it, there was an election last week. In a sense, everyone has won because voter turnout was absolutely incredible. Nearly 67% of those eligible to vote did, and that totaled about 160 million people. So kudos to you for getting out and making your voice heard. This past week has taught us many lessons, but mainly it's been a really good reminder to not listen too closely to polling. Polls showed this strong blue wave happening where the Democrats would sweep by a large margin, and that really was not the case. Races were very close, in many states, and that anticipated blue wave was really some of the reason for the market volatility that we experienced leading up to the election. And then when it became clear that that wasn't happening, markets started a pretty quick recovery after that. And we'll talk a little bit more about that in a few minutes. So there was a lot of drama surrounding this election because more people than ever voted absentee. And it seems like a far more manual process counting those votes than the votes that are cast at the polls. Races were very close, so counting every vote was extremely important. And estimates are showing that about 100 million voters voted before Election Day. So in states where you declare a party affiliation, statistics were gathered on who was requesting these absentee ballots. And you can see here in the chart that Democrats were voting early by quite a large margin. This information was known leading into the election, so the president started to issue lawsuits to states really just to delay the calling of the state to one candidate or another to try to stop vote counting, as they knew it was likely that counting all those absentee ballots in full would result in his loss. And President Trump's lawyers are trying to challenge that not all votes were cast properly or legally, and therefore they shouldn't count. So they haven't met with much success yet, as they would have to prove that enough ballots were cast improperly in enough states to flip those states to kind of overturn the results that have been announced so far. But in all fairness, this is kind of how our election process works right now. If Joe Biden were losing as the results came out, he would have found lawsuits to file as well and tried to do whatever he could to win as well. So, we've experienced this from both sides of the aisle. It's been quite an eventful year, and thus, an eventful year in the markets so far. I think we'll be glad to close the books out on 2020 soon. I know I will be. So before we can look forward, I like to take a look back at what has happened already. And the markets started this year out in January and February, kind of continuing that strong upswing we experienced in 2019. You can see kind of point number one there. We started to hear headlines at this point on this new coronavirus kind of spreading throughout China. And then in late January, the World Health Organization declared it an international public health emergency. Investors continued to shrug off this news for a few weeks after, as it really hadn't reached our borders yet, or at least that we knew of. And then cases started to crop up. We heard scary things like entire cruise ships being quarantined. People were flooding the grocery stores, panic shopping, and as the economy began to shut down to stop this spread. So this was the point really of maximum fear. And markets fell very quickly into bear territory, really record-breaking time. It only took 16 days for the S&P 500 to fall 20% from its peak in February. The economy suffered really the largest drop in gross domestic product we've experienced in such a short period of time, of over 30% as well, as businesses were shutting down. And then at point number 2, the Federal Reserve jumped in a huge way, deploying pretty much every toolkit that they developed in the financial crisis in 2008, 2009. They deployed in a matter of weeks what took them a year and a half to deploy before. So the government responded with this fiscal stimulus, in addition to what the Federal Reserve was doing, really getting money out to those who were unemployed, to families below certain income thresholds. And this is what resulted in that almost near V-shaped recovery that you can see in the chart there for both the economy and markets. So even with this massive amount of stimulus coming into the markets, at point number 2, very few were forecasting of the type of recovery that we would experience. Business and commerce was at a standstill, and the world looked pretty bleak at that moment in time. But you have to remember, it's so important that investors are always looking forward. And with the government standing ready really to do whatever it took, markets recovered at yet another record-breaking pace. So it only took 126 days for this full round trip from peak back to peak. So from really this point in February all the way back to late summer, when we were back kind of to where we began. Then we had kind of worry set in that September-October timeframe, as hope for another fiscal stimulus package dwindled. We really had COVID cases starting to make a comeback as schools were back in session. Many people were back to work. And uncertainty leading into the election spiked as investors were worried about the outcome being a contested one, worried about this blue wave and what that meant for policies going forward. And so we had a lot of volatility creep back into the market with that uncertainty in that September-October timeframe. So before I jump into some historical data on politics, this is, I think, a great time to pause and see if there are any questions from you. If you have them, please remember to type them into your chat function, and Jacqueline will let me know. Jacqueline, do we have any questions at this point?
All right. First off, good morning, everyone. Happy Veterans Day, if we have any vets on the phone. Let's see. So our first question has to do with market volatility. How did the center respond to market volatility?
That's a really good question. So it's been a busy year. You may have noticed, depending on your situation, you may have noticed more trading than normal in your accounts. We have been doing a lot of rebalancing, looking at 2019 was such a strong up year. We were looking at needing to rebalance back into bonds at that point from many investors. And we're doing so in kind of that January, February timeframe. We didn't really foresee the pandemic and the extreme downside coming that was there. We were a little worried about some things we were seeing, with the strength of the rally through 2019 and kind of wondering, maybe the market's going to take a breath at that point. We didn't see coming what did happen. So really, as we were rebalancing there, then, took a pause. The market was correcting, and we had such a drawdown. It was time to rebalance on the other side. So we've done a lot of rebalancing back into stocks at that point in time. We've made some opportunistic changes as well in some areas. So there's been quite a bit of trading. Then with the recovery kind of back throughout summer, then it was time to rebalance again back into bonds. So we have had to make a lot of changes. So if you're wondering why so many changes this year, that's why. It's been a very volatile year, causing just us to follow our process and rebalance when needed. Any other questions?
Yeah, we've definitely been rolling up our sleeves, right?
We have been.
All right, that was our question so far.
Great.
We can move forward.
Now I want to jump into some history on politics and the markets, and really look at whether markets favor one party or another being in office. So if you look at this slide, you might be surprised to see that markets don't really care which party controls the White House. I think many may view Republicans as being more pro-business and assume that returns could be far better when a Republican holds the office than when a Democrat does. But that really isn't true, as you can see by the performance of the S&P 500 over the years. It's kind of gone up regardless of who's in the office most of the time. And this is really because markets focus more on what's going on with the economy than they pay attention to politics. So it also shows, I think, that American companies find ways to be innovative and successful regardless of who is leading the country. So digging just a little bit deeper, I like to go a step further and kind of look at the composition of Congress or the House and Senate and the presidential offices and how that's affected performance historically for markets. This data shows that generally markets perform positive regardless. There are certain periods or situations that they seem to like a little bit more. But when one party is controlling, that's like the least favored outcome. It's when you get this split here on the left side of the screen. Your average returns when the president and Congress are split, so divided power, not one particular party in control. That's what markets seem to like the best. Some people may think of this as gridlock, but I don't think that's a great term to use. I'd rather look at it more as that's the opportunity when good bipartisan work can happen. Things get done, but the extreme things don't necessarily get done, and things get done in a more measured and careful way. So that's typically when you see the best performance out of markets. And this is really why we saw the market respond so favorably in the days immediately following the election. It started to become clear kind of last Wednesday morning that Joe Biden was kind of creeping into the lead. The House, it looked very likely, would stay with the Democrats as expected. And the Senate was looking like it was tilting toward Republicans. It's still looking likely that the Senate will go to the Republicans. Some races are still not called yet. We have to wait. Georgia's probably they're going to have a runoff election, but it could even be decided before then for other states, that the Republicans have taken the power there. But this outcome of these kind of good checks and balances is what the market likes to see. This removes really some of that aggressive Democratic agenda items from the table, like think of things like the Green New Deal that they've been talking about, eliminating the filibuster, an aggressive healthcare public option. So it kind of takes some of those items off the table, or at least tempers, the outcome of those decisions. So I just want to pause here real quick again to see if there are any questions before jumping into the next set of information.
All right, we will give it a check.
Also, a good drink of water.
Okay, this one is, I like this one. So you mentioned markets are agnostic to politics and focus on the economy instead. So what are some of the economic factors that the center monitors?
That's a good question. Well, we look a lot at leading economic indicators. That's kind of a consolidation of 10 kind of forward-looking economic indicators. It's something you can Google. The Conference Board puts that together every month. That's something that we look at very closely, and not just like the month-to-month change, but we look for larger degrees of change happening over a longer period of time. That kind of gives us an idea if maybe there's more risk in the economy of a recession. So that's one big one. We look at, spreads and kind of how the bond market is pricing. That might be a little bit more of a tactical indicator. We're looking at unemployment claims. We're looking at inflation, because it highly impacts investments. It highly impacts, the financial planning assumptions that we make. So there are a pretty wide variety of economic indicators that we do look at every month in our investment committee meeting.
All right, thanks. That's all we have right now.
Okay, great. So let's jump into kind of what we see coming potentially with this the new leadership. So I think one of the biggest issues that investors are focused on are taxes. So what does a Joe Biden presidency look like for our taxes? Again, I like to look back to look forward. So this is a really interesting chart kind of showing the history of peak tax rates for individuals and capital gains rates over the last 100 years. And it's pretty crazy actually how high they've been historically. But you can see now we're hovering kind of at the low end of where we've been for the last 30 years. And actually absent any additional changes. The current tax reform that went into effect in 2018 is set to sunset at the end of 2025. Now that's just for individual taxpayers, the tax kind of relief that we saw. Corporate tax rate changes aren't set to sunset. What means, if the sunset happens, that taxes kind of go back to where they were before in 2018. And I think that's something that you'll likely see the next president tackle, although since it doesn't sunset until after that next presidential election in 2024, it could even be delayed until after that. At first glance, Joe Biden's proposed tax increases on corporations, income for those in the highest tax bracket, capital gains rates, estate taxes, if those all went through, that would significantly lower the outlook for earnings of corporations and individuals. And this could hurt investor sentiment. Anytime you threaten to raise capital gains tax rates, investors assume that the stock market's going to take a hit. And while it may cause some headline volatility when that news kind of first comes out, if you look at the last time that was done back in 2012, or even farther back in 1986, this didn't really have a long-term impact on equity returns. Under President Trump, corporations had this huge tailwind from the cut in corporate tax rates, just like individuals enjoyed a cut in our personal income taxes. But when you look closely, it's likely the tariffs that we've paid because of the trade war have eaten up a good amount of those benefits. There's always this kind of push and pull. When we get something somewhere, it tends to get given back someplace else. While Joe Biden might have campaigned on this idea of raising taxes to pay for other social policies he wants to make progress on, it's unlikely with the current state of the economy, with it just coming out of the pandemic recession, it's unlikely to happen. If you look at like when President Obama took office, the economy was just coming out of that 2008, 2009 recession. And it took him many years to actually increase our taxes because of how vulnerable the economy was at that time. In the meantime, Joe Biden may be able to make progress on the trade war with China. My guess is that China might be a little more willing to come to the table with him as he's seen as less confrontational than President Trump. And this may be able to alleviate some of those tariffs, and he may be able to negotiate hopefully some more advantageous trade policies that would help our wallets rather than hurt. But the trade war is really something that's had bipartisan support. So I don't expect President Biden to go back to the way things were and undo the work President Trump has done. I think he'll continue to try to make progress on more favorable trade. But ultimately, a tax, if there were a tax increase, it could somewhat be paid for potentially by a reduction in tariffs. I like to look at this slide because it breaks down kind of how a change in taxes could impact us. This is from more the corporate perspective, it's a busy chart, so I want to step you through it. If you look at the blue bar here, this is kind of consensus. So what experts are saying earnings per share is estimated to be in 2021, so about $163. If there were to be an increase in the corporate tax rate from 21 up to 28%, which is what he had talked about, that could result in a reduction of about $9 in earnings per share, kind of right off the top. Some other things he's talked about is this, the idea that if you're a global corporation, you pay taxes in more countries than just ours, and you get to write off some of those taxes that you pay overseas. And he's talked about reducing kind of the cap on what you can deduct by about 25%. So that could result in about another $3 loss in earnings per share. And then he also has this idea of a minimum corporate tax rate. So even if you have a lot of write-offs, companies would still pay kind of this base level tax rate. And that if that were to go into place, that could result in about another $2 a share reduction. So going all the way from $163 to $149 in earnings per share for 2021 would definitely indicate, markets could correct because of that in and of itself. But if there's kind of this other side of the coin where maybe there's a de-escalation in the trade war, that could add back $8.50 potentially in earnings per share to companies because they're really struggling under those tariffs right now. And then if for whatever reason, maybe an infrastructure plan goes through, that could add another $1 per share. So if you really look under the hood at the changes that could potentially come, yes, there could be a reduction in earnings per share for companies, but not as much as it might seem kind of at face value. So while our financial planning department may be busy over the coming years working on everyone's tax projections, if there's changes, I don't necessarily see this as having a huge impact on markets. But all that being said, I think the likelihood of these tax increases even happening right now could be pretty low if the government's divided and considering the fact that we're kind of coming out of this pandemic and the economy is pretty vulnerable right now. Looking at some other potential outcomes, we've been thinking through reduced volatility is one. And could you imagine, a world where the president isn't tweeting every hour, causing the markets to swing? I mean, that in and of itself could lead to a reduction in volatility of markets for us. A stimulus bill is something that has bipartisan support, or at least about $1 trillion worth of a stimulus bill. It didn't happen coming into the election because it just became very political at that point. Congress is going back into session pretty soon, so negotiations will likely restart. And I think it's something that'll pass hopefully by year end, but probably in Q1 of next year, kind of regardless of the outcome of the election. And as I mentioned earlier, the trade war has bipartisan support, so it's likely that that'll still be adding to our headline risk, in the coming years as we work through that. But we also have this overhead of really increased government debt, and that's going to put a negative pressure on the U.S. dollar. So it's probably going to weaken the U.S. dollar going forward as it has started to already. If you look at this slide, you can see the history of how much debt the U.S. has carried in relation to our GDP. You can see it really spiked there back in World War II, and we're kind of approaching those levels again. But even before the pandemic started, we were projected to continue this climb, and it really has only gotten worse since all of the stimulus has been deployed. At some point, this becomes a danger to it, kind of like an anchor on our economy. Think of it that way. But right now, what we have going for us is we have really low interest rates. So we can afford to take on more debt, much like if you're buying a house. You can afford a lot more house if your interest rate is 3% instead of 6%. It's just like that for our economy as well. With interest rates as low as they are, the debt burden isn't as bad as it would have been if, for example, we had this debt burden 3 or 4 years ago. So, but as rates increase, we are going to have to pay attention to this because it will become more and more of a burden on the economy. Things like real assets or precious metals, international investments, those need to be in a portfolio at all times, but especially now, to combat this potential anchoring of the economy going forward. Bond markets have, the Federal Reserve has come out and reiterated they're going to keep rates lower for longer. So bond rates should continue to stay low, really meaning that the interest from our bond portion of our portfolios will remain muted as well. So that's something we're always thinking about in our financial planning projections and portfolio construction. It is still very important to have that piece of diversification in your portfolio, though, as March of this year reminded us of that. You never know when a correction is going to happen, and they just always have to be present in your portfolio. Equity markets, I think, will continue to be highly dependent upon the progress of COVID. We've had this vaccination announcement from Pfizer on Monday morning was certainly a huge boon to markets, as we saw a really strong positive day on Monday because of that. What that really means is there's this potential end in sight to these like rolling shutdowns we're experiencing to try to stop the spread. And a lot of that worry will be alleviated as this vaccination goes into production and we can start distributing it to at least the most vulnerable or the frontline workers in our population to kind of relieve some of that worry. So the degree of shutdowns, if they still happen throughout the winter, I think will dictate a lot of the path of markets. They create a lot of challenges for businesses and the supply chain. So while we have an optimistic outlook because there is this vaccination kind of coming, it is a cautious one that we want to make sure we're cognizant to balance these potential risks, meaning we want to make sure we have bonds in the portfolio in addition to our equities and continue rebalancing as we have this year when it's needed. So before we're finished, we're coming up on 11:30. I just wanted to put a last call out and see if we had any questions. I think we have time for one.
All right. So we have 3 questions, actually. The first one has to deal with Biden's tax plan as it relates to Social Security. And the question is, so if there is a hit to investor returns, any thought to how that balances with keeping Social Security? I assume most of the CFP investors are not voluntarily giving up their Social Security. So.
Social Security is always a hot button. And I think it's almost political suicide for somebody to endanger that. So I think, going forward, we're going to see more of the same. There may be slight tweaks to the Social Security, maybe as far as like cost of living adjustments or thinking of the retirement age for younger workers. But I think if you're already in retirement collecting that Social Security, I don't think you have a lot to worry about. Probably a better question for our financial planning department and something I'm sure we'll be talking about going forward. But I don't necessarily see that as something that's going to affect markets as much as more of a financial planning question. So something to think about. I think if you're a younger investor, you probably are already saving for your retirement because we never know the kind of the fate of Social Security for people, under the age of 50 or 40. And I don't think that'll change. But I think that's definitely a hot button topic.
Yeah. Really good question. Our next question is, unless the Senate flips, do you see any possibility of tax increase?
Like I said, there's that sunset provision, so it's already kind of preordained that it's going to happen if there's no action taken. But I think it could be likely that Joe Biden does try to get through some tax increases. I mean, President Obama did when he was in office, but I think it could be later in his 4-year term. I don't think with the way markets are right now and kind of this, there's a lot of individuals that just couldn't handle it right now. I don't see, I think the economy is far too vulnerable for that to happen in the near term.
Yeah, I agree. That makes a lot of sense. Our last question, if there are no tax adjustments, how are we fixing the debt? Supply side has never proven itself to work.
I've done some reading on this, and I think there's going to be a lot more focus going forward that if you want something, you have to pay for it proactively someplace else. So, if you want to have an infrastructure plan, you better have a plan for a tax increase that's going to pay for it somewhere. So I think that there's going to be a lot more pressure just to not keep racking up this debt to do things that they want to do. So I think that's one potential outcome to try to help. But if you look at like forward-looking projections, it does continue to grow and become a burden. And markets are largely ignoring it right now, but there could be a point where all of a sudden they don't ignore it and it becomes a very pressing topic that needs to be addressed. I mean, we can always hope that somebody starts working toward balancing the budget. Those types of issues might become a lot hotter topics going forward.
Yeah. I love that you emphasized before this idea of push and pull, because I do think it's a very consistent thing as we look at markets. There's always that push and pull. Those are our questions for today. So I'll turn it back over to you, Angie.
Okay, so I think key takeaways, a divided government is generally good for markets, and that's kind of what it looks like the outcome's going to be. I think taxes are unlikely to change for a while, as we've talked about, and 2020 has definitely earned its way into the history books. It's a year that we will never forget. So our hope and expectation is that through this careful work that we do with you and the financial planning, that you'll remember this is a year that's bringing you closer to achieving those financial planning goals, kind of regardless of the curveballs that the market's thrown at us. If you aren't already working with us and you'd like to learn more about it, please reach out to me. I have my contact information here on the screen and with my email address, and then that's our office phone number. So please don't hesitate to reach out if you have any questions. And thank you everyone for attending.